Hey everyone, and today we are going to talk about two interesting companies that are quietly making big moves in their industries. So the first one is an infrastructure company which added a rupee 139.7 crores metro project in Mumbai to its already strong 22,000 approx crore order book. And the second one is a branded apparel company. It posted 16% revenue growth in Q1 led by strong direct to consumer sales and lower discounting. So basically, both the companies are expanding steadily, one through focused execution in infrastructure and metro transport, and the other one by scaling branded retail through digital and direct channels. So welcome to another edition of Noisemaker, जहाँ पर we keep things simple and focus on companies that may not always come in the spotlight, but they have a really strong growth potential for the future. I am Saizal Agarwal, Equity Research Analyst at Desvelado Advisory, and today we'll be talking about two companies that are making solid progress in their business, and if current trends continue, they might continue to grow even further. But before that, let's have a quick look at the disclaimer. So any discussion, facts or writings provided here are for informational purposes only and do not constitute any buy or sell recommendation. So please conduct your own due diligence before making any investment decision. Now let's move to the first company. So Kumar Infraprojects Ltd, which is a major player in infrastructure execution covering transportation, engineering, civil construction, piling works, irrigation. So now the latest update about the company is that it won a 139.7 crores metro integration project from MMRDA, with its share being 68.4 crores via 49% joint venture stake. And this ties in well with their sharp focus on Mumbai's metro ecosystem, where they already have deep execution experience, strong local collections, and existing project resources. The best part is a short 18-month project, meaning quicker revenue recognition, and it runs parallel to their larger projects like the GMLR tunnel and Chennai elevated corridor. Plus, they are also sitting on a healthy 22,238 crores order book, and they are bidding for another 20,000 to 25,000 crores worth of contracts. So clearly, they are balancing long-term growth with short-term execution. This also improves visibility for their FY26 revenue target of 6,500 to 6,600 crores and order inflow guidance of 6,000 to 8,000 crores. So now Nishant would be joining in for more. So Nishant, looking at this mix of short and large orders and their strong hold in metro work, how do you see their overall execution momentum shaping up?
Yeah, thanks, Hazel. What stands out to me is the steady execution rhythm across quarters. In FY25, revenue grew 16.7% year on year from rupees 4879 crore to rupees 5690 crore, and even in Q4 FY25, they clocked rupees 1633 crore. That's a 9.8% sequential growth, which shows the pace is consistent. On the other hand, EBITDA rose to rupees 826 crore from being rupees 704 crore, with margins holding at 14.5%, and net profit also improved to rupees 390 crore, keeping net margins stable at 6.8%. That shows they are not just booking revenue, they are doing it with cost control and operating discipline. So overall, I think they have built a solid platform to maintain execution even as project complexity rises. But Sazel, what's your take on their upcoming capex and how they are planning to handle these larger infra jobs?
Good point, Nishant. So, what caught my attention is their proactive investment strategy. As they are planning capex for tunnel boring machines and elevated corridor equipment, and that means for projects like GMLR and Chennai corridor, they'll no longer heavily rely on third-party contractors. And owning to this equipment gives them more control over timelines and cost, and also strengthens their position while bidding for future complex infra projects. Plus, there is a financial angle here. They have bought a distressed industrial asset which they plan to sell in the next 12 to 15 months. And if successful, this sale could fetch them 30 to 40 crores, which will further be used by them to reinvest or use to reduce the borrowings. And that shows that they are trying to create internal funding cushions rather than raising the fresh capital. So, what do you think, Nishant, that this approach reflects smart capital planning, or are there risks they still need to manage?
Yeah, I think it's a well thought approach. The company is clearly trying to build long term capacity without compromising short term liquidity. Buying TBMs isn't cheap, but it positions them strongly for metro tunneling work, which is only set to grow. And the potential rupees 30 to 40 crore asset monetization, that's a clear way to self fund future needs and avoid unnecessary debt or dilution. Of course, they will need to be cautious about execution timelines, especially with parallel large scale projects running, but overall they seem to be striking the right balance between aggression and discipline. So to sum it up, J Kumar Infra Projects look well positioned, strong order book and active bidding pipeline, mix of fast and long cycle projects for cash flow balance, capex aimed at self-reliance and deeper project control, asset monetization to support funding without financial strain, and if they stick to this strategy, they will likely to remain a key player in the upcoming wave of metro and urban infra development.
Okay, thank you, Nishant. So now let's move to the second company. So, Arvind Fashions Ltd, it operates in branded apparels, beauty and footwear segment and manages a mix of both owned and licensed global brands. So, in Q1 FY26, the company delivered strong performance. Revenue grew 16% year on year, led by broad-based growth and continued push in direct channels. Like-to-like sales were up by 8.1% and online B2C grew 30%, which also aligns with their strategy of building out a stronger omni-channel presence. And even with higher ad spends, EBITDA rose 20.3% year on year to 148 crores, with margins improving to 13.4%. And PAT also jumped sharply from just rupees 1 crore in Q1 FY25 to 13 crores this quarter. So, Nishant, considering this Q1 strength and their focus on digital first retailing, do you think this is a real turnaround or just a seasonal bounce?
Yeah, that's a great point, Cecil. Looking at the broader trend, I would say this is part of a steady structural shift, not just one of bounce. Let's step back. FY20 revenue grew 8.5% year on year from 4259 crore to rupees 4619.8 crore. Not dramatic, but steady. EBITDA on the other end also improved to rupees 637 crore from rupees 544 crore, with margins rising to 13.8%, showing operational efficiency is also improving. But where things got tricky was the bottom line. Net profit dropped from rupees 106.5 crore in FY24 to rupees 34.4 crore in FY25. Most of this was because of a weak Q4. They posted a big loss, possibly due to excess discounting, inventory cleanup, or cost pressure. So yes, the Q1 FY26 performance shows they have corrected course, but I had keep an eye on profit consistency going forward. What about you, Cesar? How do you see their store expansion plan and capital light FOFO strategy playing into this?
Absolutely, Nishant. That's where I think Arvind is playing smart. For FY26, they plan to open around 150 new stores, but through the FOFO model. And that's franchisee owned, franchisee operated. And this helps them to expand faster without locking in too much capital. And most of the focus is on mono brand outlets for US Polo, Ascension, and Arrow, which are already the strongest performers for them. So they are doubling down on what's already working for them and using a model that reduces the risk for them as well. Adding to that, the timing might work in their favor because the company is banking on a early festive season and a good monsoon to lift the demand. And if that plays out, it can really boost walk-ins and discretionary spending as well, especially in the tier 2 and 3 cities. So, Nishant, with this expansion plan and signs of a consumption recovery, what do you think that Urban Fashions can finally deliver profitable scale?
Yeah, that's the key question. I would say they are moving in the right direction. The FOFO model keeps the balance sheet light, while the brand focus ensures the new store don't just add top line but also contribute to margins. But the real challenge is bottom line consistency. They have shown they can control discounts and lift margins, like we saw with gross margin improving to 55.9% this quarter. If they keep that up while scaling, it could lead to a stronger profit trajectory. Also, the ROCE guidance improvement through better channel mix and tax optimization shows a mindset shift toward capital efficiency. So, to sum it up, Arvind Fashions uh, looks to benefit from steady growth in direct and digital channel, capital light store expansion, and with strong brands, margin recovery through lower discounting and better cost structure focused efforts on ROCE and profitability improvement. And if they can stitch to it all together, literally. and financially, they might just emerge stronger in India's fashion retail space.
Thanks a lot, Nishant. That really helped us to understand the direction both the companies are moving in. So now let's take a quick look at how some of our previous picks have performed. So first is Nova Agritech Limited, which we picked up at 49.5 rupees, and it's now at 56.8, giving a return of 14.7%. GMM Pfaudler Limited, it's from 1271.4 to 1284. That's a gain of 0.9%. Oriana Power Limited, it moved from 2,190 to rupees 2,175.9, delivering a slight 0.6% decline. Then Paras Defence and Space Technologies Limited, this one saw a dip from 818.9 rupees to 699.4, which is a minus 14.6% fall. And lastly, Gabriel India Limited, which we picked up at 842 rupees, which is now at 983.9, giving a return of 16.9%. So overall, a pretty good mix of gains, and we'll continue to monitor all these companies closely to see how they shape up in the coming quarters. And here is the QR through which you can access all these previous picks which we covered recently. Now let's move to the summary of the companies which we included in today's recent filing. So the first company is Kumar Infraprojects Ltd, which secured a 139.7 crore metro integration project under 49% joint venture supporting its 6,500 to 6,600 crore FY26 revenue target. And Arvind Fashions Ltd, the company reported Q1 FY26 revenue of 1,107 crores, up by 16% year on year, with PAT rising to 13 crore on margin improvement. So that's it for today's edition of Noisemaker. And if you find this breakdown informative, you can scan the QR code to read the full report. And we'll be back soon with more simple and clear market updates. Until then, stay curious, stay ahead, and stay informed.